Are you clean, clear, and ready to listen? Good, because we need to talk about a silent financial killer that is waiting for you the second you cross the finish line into retirement. It is the IRS, and it is the absolute lack of a tax strategy. Listen to me, you have worked 30, 40, 50 years to build up your nest egg. You saved, you sacrificed, you did everything you were told to do. You put money into your traditional 401k or your traditional IRA, and you watched it grow. You thought you were doing great. But what you did was build a financial ticking time bomb. You built a massive debt to the federal government, and you don't even realize it because nobody told you the rules of the game change completely the day you stop earning a paycheck. When you are working, taxes are simple. You get a W-2, you take your standard deduction, and you pay your bracket. But the second you retire, you enter a tax minefield. You are no longer control-free. Every single dollar you pull out of a traditional retirement account is taxed as ordinary income. And if you do not understand how those distributions interact with your Social Security and your Medicare, you are going to get slammed with a tax bill that will absolutely gut your retirement dreams. I hear the fear in your voices every single day. Susie, what if I run out of money? Susie, what if inflation eats my purchasing power? Let me tell you right now, it is not inflation you should be terrified of. It is your own ignorance of the tax code. You are afraid of losing what you've built, yet you are willingly handing it over to Uncle Sam because you are making the exact same 5 mistakes that thousands of retirees make every single year. Let's start with the first massive blunder, the Social Security tax trap. You think Social Security is tax-free? Think again. If you have other sources of income, like a pension, or withdrawals from your traditional 401k, up to 85% of your Social Security benefits can be taxed. It is based on something called your provisional income. If you are married filing jointly and your provisional income crosses just $32,000, or if you are single and it crosses a measly $25,000, the IRS is putting their hands right into your Social Security check. You are being double taxed on money you already paid into the system. It is a travesty, but it is the law, and you have to know how to navigate it. The second mistake, and this one makes my blood boil because it catches people completely off guard, is the Medicare premium spike, known as IRMAA. Income-related monthly adjustment amount. It sounds like a bunch of bureaucratic nonsense, but it is a massive surcharge on your Medicare Part B and Part D premiums if your income goes just $1 over the limit. For 2026, if you are a single filer and your modified adjusted gross income goes over $109,000 or $218,000 for a married couple, your Medicare premiums don't just go up, they rocket sky high. They can double, triple, or quadruple. And if you fail to take out the exact right amount, the penalty used to be an astronomical 50%, and even now, it will devastate your account balance. These forced distributions add to your taxable income, pushing you into higher tax brackets, triggering the Social Security tax, and triggering those Medicare IRMAA surcharges. It is a vicious domino effect. The fourth mistake is the absolute failure to utilize a Roth conversion strategy while you are in the tax valley. The tax valley is that beautiful, golden window of time between the day you retire and stop working, and the day you are forced to take RMDs and collect Social Security. Your income is artificially low during these years. This is your moment. If you sit on your hands and do nothing during these years, you are wasting the greatest tax planning opportunity of your entire life. And finally, the fifth mistake is pulling money from the wrong buckets in the wrong order. When people need cash in retirement, they usually just grab it from whatever account is easiest, or they drain their taxable bank accounts first because they think keeping the tax-deferred accounts growing is always smart. It is not. If you blindly drain one asset class before touching another, you are setting yourself up for a massive tax spike later in life when you are left with nothing but heavily taxed traditional retirement accounts. So, what is the actionable takeaway here? How do you protect yourself? You must become a warrior for your own wealth. First, you need to execute strategic Roth conversions during your low-income retirement years. Move money from your traditional IRA into a Roth IRA systematically. Yes, you will pay taxes on the money you convert today. But you are paying those taxes at today's historically low tax rates, and you are doing it on your own terms, in an amount that you control so you don't push yourself over those Medicare and Social Security thresholds. Once that money is inside the Roth IRA, it grows completely tax-free, and more importantly, it is never subject to required minimum distributions. You are killing the tax bomb before it can detonate. Second, you must manage your income to the single dollar. Before you make any financial move in retirement, before you take an extra withdrawal to buy a new car, or cash out a stock to go on a vacation, you must look at where you sit relative to the Social Security taxation thresholds and the Medicare IRMAA tiers. You need to blend your distributions. Take a little from your traditional IRA, take a little from your Roth, and take a little from your regular taxable savings so that your total income stays safely below the cliffs. Do not tell me you can't do this. Do not tell me it is too complicated. If you can spend decades working for your money, you can spend a few hours learning how to keep it. You have to be strong, you have to be smart, and you have to be secure. Take control of your retirement tax strategy today, because if you don't, I promise you, the IRS will do it for you, and you will not like the results.